This is the review for homework assignment 4 and covering chapter 5, which is risk and return for investment class. I will go over each of the questions, including the Excel questions at the end, and you can follow this video for getting guidance of the questions. Now, first questions, the market premium is best approximated by the difference between return on an index fund and a return on a treasury bill. So treasury bill is the right risk-free rate. So first of all, if I were you when studying this questions or looking at this question, I will look for what is the definition for market risk premium. And you'll find it in the slides. You'll also find it in the textbook. So the risk premium is basically the return minus the risk-free rate. And market risk premium is therefore market return minus the risk-free rate. So risk-free rate is usually represented by treasury bills, a short-term government bond. Short-term, which is usually 1 to 3 months. So there is no long duration out there to expose investors to extra risk. So it's going to be short, liquid, and basically no risk to be too concerned about. And then here, this is what we want. And the index fund is usually a passive managed fund. And it's passively managed because it has a diversified portfolio, and it basically usually follows the market. So very likely the return of index fund is a return of market portfolio. So next is B, the difference between return on a small firm mutual fund and return on S&P 500. So we are not seeing what we are looking for here. We are looking for market risk premium, which is market return in excess of the risk-free rate. So there's no risk-free rate here. There is a market return here, but it's taking the wrong difference. So question, and then option C, the difference between return on the risky assets with the lowest return and the return on treasury bills. So we got the return on treasury bill, but this risky assets with lowest return is not what we are looking for market return. And then next one, finally, difference between return on highest yield assets and return on lowest yield assets. This is basically an option that is not relevant. Okay, moving down. So both investor and gamblers take on risk. The difference between an investor and a gambler is that an investor, A, is normally risk neutral. That is not true. Investors are risk averse. B, requires risk premium to take on risk. And this one is correct. So I'm going to choose this one for B and this one for A. A for first, B for second, and I'll explain why. So first of all, risk averse is a characteristic of investors. Risk loving is a characteristic for gamblers. C knows he or she will not lose money. So for gamblers as well as investors, I think they all know that they will lose money. D knows the outcomes at the beginning of the holding period. This is unknown for both investor and gambler. So both of them are facing a situation where there is a likelihood of gaining and the likelihood of losing. So the real difference is that for gambler, for our individuals that has a risk-loving attitude towards taking on risk, they will still take risk even if it's losing money. They just love to take on risk. So therefore, they are not asking you to compensate me or offer me any extra compensation for asking me to take extra risk. So that is the main difference. And investors, however, are more savvy, and they require compensation for risk, any risk that that is attached to the assets that they're investing in. So the more risk that the company or the assets has, the higher risk premium the investors will require. So so B. Number 3, historically, small firm stocks have earned higher return than large firm stocks. When viewed in the context of an efficient market, this suggests that small firms are better run than large firms. So we have a question mark here. The stock prices is higher, does means that the firm is doing well, but it does not mean that, but there are other things that driving the performance as well. So it's not necessarily wrong, but it's ignoring some other factors. So second one, government subsidies available to small firms produce effects that are discernible in stock market statistics. So that is not true. So I think government subsidies are available to both small firms as well as large firms for the projects that has potential. And small firms are riskier, and also government subsidy does not really play a role here for the pricing of the firm. It plays a role, but it is not the number 1 factor or number 2 factor. So it's not as important as the firm's own operation and the risk that they're taking. C, small firms are riskier than large firm. So this one is something that I'm looking for. The reason is that we are simply telling investors the outcome, the return of the investment. So here, now we're talking about a return of a risky asset, right? Now, in the market, the higher risk is associated or is required by investors for higher compensation. So, so therefore, on average, you see that small firms' prices are much more volatile than large firms. So if you still want, so if for the company, they still want investors to invest in the firm, they're not stupid. They want a better return. So so simply because let's say an investors want to hold this firm for 1 to 5 years, and then for small firms, it may not get better in 1 year. So after 1 year, after holding this small firms, the investor may see their value even decrease from the initial entry point. So this is the volatility, and this is the risk that we are talking about. The risk is that the investment may lose money. So so over the long run, of course, if this company is indeed running a few projects that is promising, so over the long run, they may clear out the barriers, they may clear out the concerns on their path, and then be able to make successful projects. So that's over the long run. And so hopefully over the long run, or by looking at many small firms, and the net effect of small firms is that they overall is able to achieve better financial performance. So then if you're just looking at financial performance, just comparing to themselves, they maybe have a better growth. So so that's basically tells you this is a risk story. So it's not a higher return story. So when you're looking at the risky investment, you should look at its return as well as its risk. So if you're just looking at its return, you're not able to understand the full picture. So a firm that has higher return may simply means that they're doing more riskier projects that may or may not succeed. So in that sense, investors would pay a very low price now. Otherwise, they are not willing to participate in investing this firm. So then in the future, when the return is realized, it looks like a very high return. So currently pay a low price, and then in the future, realize a high price relative to the current price that they are paying. And that is the higher return that you are seeing. So the higher return is at this moment is due to a very low price that investors is willing to give for the firm. So here, because firm is riskier, so that's the main reasons that investors don't want to pay a high price. This is basically the risk premium that we are talking about. They currently are concerned about the risk. If you still want them to invest, then in the future offer me better return. So D, small firms are not being accurately represented in the data. So D is basically questioning the data. So this is so when you look at this, probably based on your knowledge, you're not able to tell D is right or wrong. But you know, when you are seeing an option, I'm saying about working on questions like multiple choices. So you may want to choose the ones that you are more confident with. So you choose the one that you certainly know that this is right. Or choose the one or exclude eliminate one option that you certainly know that it is wrong. So then you find the most correct option, choose the most correct option. And for D, so based on my knowledge, or if you read the book, you know that this effect that smaller firm earns higher return has lasted for more than 100 years. So it's there. It's not it's not subject to any data issue. So it's not a small sample. It's a large sample over a very long period that that shows that small firms has higher risk premium than a large firm. And fourth one, which of the following arguments supporting passive investment strategies are correct? So it's asking you to choose the correct one. I'm going to highlight the right one here. So choose the correct one. So number one, active trading strategy may not guarantee higher return, but guarantee higher costs. So this is absolutely correct. And then the difference in terms of fee between passive and active is that, of course, you need to pay higher fee if you want somebody to actively manage the portfolio for you. So passive investment strategies usually is known for its low fee. And it's not guaranteed. So high return is not guaranteed under any of the strategy. So actively managing may or may not work. So it always depends on the skill of the manager. If you have found a manager that really have good skill in picking stocks and really have good skill in timing the market, then it may beat the market. But if you have like mediocre fund manager, and they are doing average things, and they make wrong decisions, it doesn't matter how active that they are trading, the portfolio will lose money just because there's no skill and so the higher return cannot be guaranteed by active trading. So second one, passive investors can free ride on the activities of knowledge investors whose trades force prices to reflect currently available information. Passive investor can free ride on the activity of knowledge investors whose trades force prices to reflect currently available information. I think this is right. So basically, this whole part, knowledge investors whose trade force prices to reflect currently available information. To summarize it in one word, is that if the prices reflects all the information. So if prices reflect all the information, that means that there is no mispricing over there. So no mispricing in the market means that nobody can gain abnormal return. So you have your analysis, I have my analysis, but none of our analysis are able to help us to lead to a better return, simply because the prices has already reflect all the available information out there. So even though you analyze the information, that doesn't mean that there is new information out there. So that means price is efficient. So when price is efficient, nobody can predict price in the future. So in that sense, passive investors are equal. So they are having equal opportunity as some knowledge investors. And because of efficient pricing out there, and efficient pricing will actually benefit passive investors, because that means everyone just do everyone just perform so the knowledge investors, they are hoping that they can select stocks or time the market. They're hoping that they have better knowledge than other ones. That will offer them a sustainable investment strategy. So not due to pure luck. There are always cases where people tell you that I buy this and this give me how much of the return. So, but those are individual cases. You want a sustainable long-term investment strategy that works all the time. So with efficient pricing, passive management strategy will be basically buy and hold, don't select, buy and hold the market and don't select. And this work when the prices are efficient. So in some market, when there is segmentation and when there are frictions, so maybe the financial system in the country is not well regulated, so prices are inefficient, and inefficiency is happening everywhere in the market. So in that case, passive investment strategy is probably not going to work, because on average, the pricings are inefficient, and there are chances for you to exploit some opportunities here and there due to the mispricing, misvaluation out there. So so passive will definitely fail comparing to active. But in an efficient market like the US financial market, here most of the time or over the long term, it is efficient. So in that case, passive investment will probably work. So next one, passive investors are guaranteed to, nothing is guaranteed. Again, in investment, unless you are investing in risk-free assets like treasury bills, or you're putting money in a money market fund, those cases you have interest rate for sure. But other risky assets none of them can offer you a higher rate for sure. So so this one is obviously wrong, so I'm gonna eliminate this. So number 1 and 2 is the right choice. And question 5, which measure of downside risk predicts the worst loss that will be suffered with a given probability? And that will be VAR, value at risk. So value at risk is basically looking at the worst case scenario, how much money you will lose. If there's a 5% chance that worst case scenario, that's VAR at 5%, then we're looking at a 5% chance this worst case scenario may happen. And in that case, this is how much money that you may lose. So that is the VAR measure. It's a downside risk measure. So standard deviation is a risk measure for total risk. Variance is similar to standard deviation. It's just a square of standard deviation. It's also a total risk measure. Sharpe ratio is reward to risk measure. And 6, rank the following from highest average historical return to lowest average historical return from this time period. So you may now have a better idea of lower risk assets. And we're starting from the risk-free asset first. So we saw that now I'm able to see the risk-free asset T-bills here. So that will be definitely number fourth here. So eliminating B. And the second lowest risk is probably bond relative to stocks. So number two is four, number three is two. So we have 4 and 2 here, going from my right-hand side to left-hand side. And then the second largest risk, comparing to small stocks, I think large stocks is less risky. So we just talk about it why. So then 3 is the second risky, second highest risk asset. And then the assets with the highest risk is small stocks among the 4. So so the right order will be 1, 3, 2, and 4. And there is some numerical question here. You manage an equity fund with an expected risk premium of 11% and a standard deviation of 26, treasury bill 5.2. The client chooses to invest $50,000 in the equity fund and then 150 in the T-bill. What are the expected return and standard deviation of your client's portfolio? Okay, so we're going to do some math here. The formula is in the slides. So I'm going to pull up the slide here, slides for chapter 5. So here is the way of calculating total portfolios, the complete portfolios return and the standard deviation. So we'll start from RC return equals to the proportion. This is the weight and divided by, probably use a better way of writing it. Inserting mathematical equation. So $150 is the numerator, and the denominator is the total investment. That will be the weight for risk-free asset. I probably need to follow this. So the first part is risky assets weight. So I probably need to follow the formula for better illustration. And then the risk premium is 11% plus 1 minus the rate times risk-free rate, 5.2%. Equals to okay, so I'm gonna see if the calculator can read this formula. It has got me 6.75%. 6.75%. I need to check whether it's correctly calculated. So first one is this 0.25. Let me see. So we have 5 over 20. So that is 1 a quarter. So that is 0.25. So that is correct. Equals to okay. Now let's see. Yes, I think it's correct. So nice thing that you can directly copy this formula. So copy this to the calculator and it's gonna give you the answer. So 6.75%. And then standard deviation, standard deviation's notation is sigma. So I'm gonna use sigma equals to 0.25 is the value for y times the sigma of the risky asset, which is 28%. And that will gives us, going back to the calculator, that will gives us 7%. 7% standard deviation. So 6.75 and 7% is what we are looking for here. So roughly 6.75% for return and 7% for the standard deviation. All right, so next one. So we have got here the questions. You invest 1,000 in a complete portfolio. The complete portfolio is composed of a risky assets with an expected return of 16, a standard deviation of 20, a treasury bill of 6, a portfolio that has an expected return, expected value in 1 year of 1,100. Could be formed if you, how to form this. So we want to figure out the weight Again, we're using similar formula up here, but in a different way. So formula is the same, but the application is going to be slightly different. So we expect 1,100. And the weight is unknown, so we're solving y here. And I believe the return is 10% on the left-hand side, but just in case you don't know, so our return here R equals to $11 minus 1,100 minus 1,000 divided by 1,000. And that equals to 10%. Okay, so in case you wonder, because the initial investment is 1,000 and the end of the year expected value is 1,100. So that's so the investor that we're trying to deal with is having a 10% expected return. So we're gonna put 10% on the left-hand side for the portfolio that he's investing. And then we don't know why. So we want to figure out why here in this formula. So we're using y times the risky return plus 1 minus y times 20% standard deviation. Not 20% standard deviation, but the risk-free rate here. So that basically mirrors this formula. So we put everything down. We just don't know why, but we know all other numbers. So the expected return is 10, and the risk-free rate is 6%, risky return 16%. So now it's my time to show you how to move the right-hand side variables to the left-hand side. So we want to isolate y. 10%, I'm writing everything down just to expand everything in the bracket. So I got 0.16 y plus 6% minus 0.6 y. And still writing everything down, left-hand side 0.1, and right-hand side becomes 0.1 y, because I'm combining these two y. So 0.16 minus 0.06 equals to 0.1 y plus 0.06. And then I can do more rearranging here. Rearrange 0.1 y to the left-hand side. And then I have got 0.1 minus 0.06. So I'm putting everything down as well, but I'm able to calculate the number on the right-hand side, which is 0.04. And then finally, y equals to 0.04 divided by 0.1. And the calculator tells us that that equals to 0.4. So y equals to 40%. So 40% simply means that invest 40% in the risky asset. So Y is the weight for risky portfolio. So in this case, A is the right answer. All right, next one, question 9. Invest 10,000 in a complete portfolio. The complete portfolio is composed of a risky asset with the return this, standard deviation this, risk-free rate this. How much money should be invested in the risky assets to form a portfolio with an expected return of 11%? So this is very similar, asking you to solve for the weight. So I'm going to copy everything down. Just changing some numbers here. Our expected returns is 11%, so I change 10 to 11. And then the risk-free rate is now 5%. Risky assets, risky portfolios return is 15%. And I'm solving it following the same procedure. 0.555. So I have got 0.1 here, 0.11 on the left-hand side, and here is 0.05. So on the right-hand side, this and this. 6.06 and 0.06 divided by 1.1, then that will be 60%. So our total investment is 10,000. So then the dollar value will be 10,000 times 60%, which is 6,000 for a risky portfolio. So we're choosing 6,000 here. And then next, your investment has 20% chance of earning 30% rate of returns, 50% chance of earning 10% rate of return, and 30% chance of losing 6. What is your expected return on this investment? So then it's the weighted average. Very simple. We worked on it in our class Excel exercise. We work on how to solve for expected return when we are given the likelihood. So basically, we are using likelihood times the return. Weighted average is using the weight times the variable plus another weight times the rate of return under this scenario. And the worst case scenario, 30% chance, 30% likelihood, and a negative 6% return. Let me see if the calculator is able to work out. Okay, it's not able to work it out. So I'm gonna do it one by one. So 0.18 is probably the first. Let me see. Times. Okay, 600. So 6%. Plus 0.5 times 0.1. 5% plus 0.3 times 0.06 equals to 0.18, negative 1.8. Yes, equals to 6 plus 5 minus 1.28, 9.2. Okay, so we got 9.2% here. Okay, moving down, if you have the rate of return for a risky portfolio for several recent years, and the return shows like this, if you invest 1,000 at the beginning of 20, I believe this is 2016, and then you invest at the end of 2019, then the worth would be, so we'll be calculating cumulative return. So cumulative profit times 1 plus the return here times 1 plus return in the second year times 1 plus this. And 1 plus 23.45 equals to, now I probably use Excel to calculate this. Equals to this. Enter. It has, okay, it has a dollar sign. Get rid of the dollar sign, just put in 1,000. And what does it say? Here. Okay, how about me change it to 0.0? 0.0. Enter. Still is not working. Hold on. So the question 0.0, 0.09. I see. So I think it was previously noticing my minus sign as a dash, not the operating symbol. So 1325, 1325. So I don't see a right answer here. Okay, let me just double check it. Okay. All right, 1785. So that is here, 1785. So what's wrong with this two formula? Oh, I see. My error is that I should get rid of this percentage here. Enter. So then these two will be the same. So 1785 for this question. So I think the formula is not that complicated. The key is you want to make sure that the calculation that you're entering is correct. No matter you use Excel or your calculator. So always make sure that you crunch the right number. So final question for multiple choices. The return on risky portfolio is 15%. The risk-free rate as well as the investor's borrowing rate is 10%. The standard deviation of the return on risky portfolio is 20%. If the standard deviation on the complete portfolio is 25%, the expected return on the complete portfolio is. All right, so I'm gonna copy the formula down. And then also copy the calculation for standard deviation down. So calculation for standard deviation is we're calculating sigma of the complete portfolio, which is proportional to the sigma of the risky portfolio, and we are solving y. And then for solving y, we're just rearranging the formula here. I'm gonna do separate y, and this will be 25% divided by 20%. Oops, 20%. That will be the half of 25, which is 12.5. Oops. Oops. Yeah, 125. So let me just double check. 0.25 divided by, oh, sorry, 0.25 divided by 0.2. Make sure it is correct here. Okay. 125. So let me just double check. 125 times 20% equals to 25%. So that is correct. So 125% for the weight. So the reason that I want to double check is that that basically means that you want to overinvest in the risky portfolio. So borrowing 25%. So 1 minus y will therefore equals to 1 minus 125% equals to a negative 25%. All right, so that is y. And the risky portfolio return is 15%, so I don't need to change 15% here. Investors borrowing rate is 10%, so I'm changing this to 10%. And we're solving for R. And I need to change the Y to the Y that the weight that we calculated. And this one will be negative 25%. All right, so copy it to Excel. So that gives 16.25% here. And that is the last option. So D for question 12. All right, so next we'll move on to Excel question. So 13 to 18. Excel questions. So I have these Excel questions. These are fun questions. So don't be too afraid of touching your laptop and working on the Excel. It's gonna be fun. So let's see. So question 13. So we have following tables contains the holding period return. So we have holding period return here for 3 companies, and use the return above calculates the stock's average over various time interval. So we're gonna calculate the arithmetic average as well as geometric average. So for arithmetic, simply it's the return. Average going down. And in case you don't know, I already gave out the formula. So if you have really looked into this Excel file, scroll it down, and here will be the hint for each of the Excel formula. And next is average. I'm using average, which is the same as taking the sum and divided by the number. So average function. And I can probably drag it. So calculating the average of the third firm. Next is the geometric average. So that will be the product of 1 plus a return here, a bracket, and raise this to the power of 1 divided by count years. And minus 1. and then drag away to the right. And this, and this. Okay, so first question done. Move on to question 14. All right, use the information in the table above and calculate the contribution each stocks makes to the portfolio performance, then calculate overall portfolio performance. And the weight is listed here, and the portfolio and each of the return is listed here. The contribution of return equals to the weight times the return. So I'll be just dragging it down and then take the sum of all of these. All right, easy. So it's easy to operate everything in Excel. So if I calculate it manually with the calculator, I will make a mistake. I know that I will make mistake. So to avoid making mistakes, I'll open up my Excel file to calculate all of these. So question 15, it's a scenario analysis. Okay, great. Consider the performance of stock market and based on the state of economy, using the information, calculate mean variance standard deviation of holding period return on the market. So it's asking us to calculate mean variance and standard deviation. So we'll follow what we went through in the class. So first of all, we use the weight times the return. So column B times column C. Column B times column C. And then the mean will therefore equals to the sum of the above in percentage point. That will be 13%. Next is we calculate the deviation from mean. So which is the return deviated from mean. I'm going to add a dollar sign here to fix this cell because mean is always the same one. Drag it all the way down. So this is deviation from mean. Okay, so next is we want to calculate the square deviation from mean return. Which is taking the square of the deviation. And here will be column B times column F. Column B times column F. Hold on a second. I think there is issue here. Okay, there's no issue here. Good. 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 And good. So the variance will be the sum and standard deviation will be the square root of variance. I'm gonna use percentage point. So therefore, mean equals to this variance equals to this, and standard deviation equals to this. Complete. Question 16. Suppose we are managing an equity fund with the following securities. A client invests partially in your fund and partially in treasury bills. So complete portfolio. And the portfolio composition is looking like this. And the asset allocation decision looks like this. 30% on risk-free assets and 70% on risky portfolio. All right, so what is the question asking? So it's asking us to first calculate the expected return of the fund and the expected return standard deviation for the investors. Good. Expected return for the fund, that will be the weighted average. So I'm going to use weighted average function in Excel, which is called sum product. And you will need to give Excel the weight average and the return average. Comma, and the weight. So the order doesn't matter. So yeah, as you can see here. So every 1, every 2, every 3, every 4. So you can switch the order of 1 and 2. So that doesn't really change the final result. So 14%, that is the risky portfolio's expected return, and the investors' expected return is what we are practicing in also the multiple choices, the same formula. So we are using the weight, 70% times risky assets return plus the weight for risk-free assets times risk-free rate. And the risk-free rate is here. And I'm gonna hit enter. And then for the standard deviation, the sigma will be weight times the standard deviation of the risky portfolio. All right, then Sharpe ratio will be, if in case you need the formula, so the formula is like this. Sharpe ratio equals to risk premium, which is defined as return minus risk-free rate divided by the standard deviation. So we need return here minus the risk-free rate here. Put a bracket here, divided by the standard deviation of the risky portfolio. Probably showing it with, yes, not in percentage, with decimal point. And then next is the same. We're trying to find investors' total return minus risk-free rate divided by the standard deviation. All right, changing the format of the cell. And if you calculate correctly, these two numbers should be the same. And S&Ps, we want to compare, right? We want to compare investors' choice, this risky portfolio's performance, a risk-reward adjusted return performance by comparing the Sharpe ratio with a benchmark. So benchmark is earning 12% return. So the premium will be 12% minus 2.5 divided by the standard deviation. And it has higher Sharpe ratio. It has a higher Sharpe ratio. So the market is doing better. So on the market, S&P is doing a better job than the individual's portfolio. That's simply what Sharpe ratio tells us, that the efficiency of earning return over 1 percentage point of risk standard deviation that you're taking. So the investor's portfolio or the fund is basically earning 0.4, but the market is able to earning 0.47. So 0.47 is slightly higher than 0.46. So that means that for bearing the same amount of risk, the market S&P 500 is able to generate a higher return. Next is question 17. So in this questions, I would like you to basically calculate the standard deviation and variance and return over a time series. So now that we have a time series here, so for number of return, you just need to calculate the count. For this, enter. Average return will be taking the average. So I'm hitting Control Shift and a downward arrow here. So if you're using Mac, hit Command Shift and the arrow that is pointing downward and enter. So then variance will be the variance function. We're choosing variance sample variance here since we don't have the full population of the data. So we only have a sample. And enter. And standard deviation is very much similar, choosing sample standard deviation, enter. Now we got everything we need, and we just need to drag it to the right so that it moves correspondingly to the next column. So for 30-year Treasury bond yield and for S&P 500, and you're gonna see that both of these two are lower. So bill yield is the risk-free rate. 30-year Treasury bond yield is the slightly but still low risk assets. It's not zero risk but low risk assets. And the S&P is a risky portfolio. So you can see that for the risky portfolio, its risk measure is therefore higher. So standard deviation is 16% comparing to a really low standard deviation for Treasury bill yield and the Treasury bond. So this is how we get return from his time series data. So we're using historical return and taking the average. So most of the time, people will use this 12.5% as their benchmark return or as their expect. In the formula, use it as expected return for the market. But that doesn't mean that you'll get this 12% in every single year. And you can see that if you're just looking at a historical pattern, some years are negative numbers, some years just have single-digit growth, some year has 30%, 20% growth. So that's the volatility. The volatility is that, okay, I know that over this 30-year period, on average, if I hold 30 years and do nothing, my return and my average return will be 12%. But in every single year, nothing can be predicted. It could be a negative number. So your portfolio is subject to this risk. So depending on which year that you're opening that you're looking at the number, the balance in your portfolio. So in a good year, it's higher. In a bad year, it may be a lower number than you previously look at. So when the year has been accumulated for a longer time, so then the return then the overall investment will gradually grow because on average the return is positive. Okay, finally, we have got questions for comparing the performance of the portfolio for the Sharpe ratio. So here we got 4 different securities, and the risk-free rate is 5%. So we have expected return I showed up here. So 15%, 1%, 12%, 13%. And the variance is shown here as well. So we want to develop a complete portfolio by comparing the risk-free assets with one of the securities mentioned above. So A, B, C, and D. The security with investors should choose as part of her complete portfolio to achieve the best capital allocation line will be, so the best capital allocation line will be the portfolio that connects the risk-free asset and the risky asset, and the slope should be the highest. The slope, it happens to be Sharpe ratio. So we want to calculate the Sharpe ratio for each of the securities here. And let's start. So we need a standard deviation. So we need to calculate standard deviation equals to square root of variance. I drag it all the way down to the last security. And the risk premium is return minus risk-free rate. I'm going to fix this risk-free rate by adding the $sign, enter. Good. So then Sharpe ratio equals to risk premium divided by standard deviation. Enter. Okay, I'm gonna make them showing up in 3 decimal point. So now you're able to tell which one has the highest Sharpe ratio, and that will be security A. All right, so that would be the end of the review for homework 4, covering chapter 5.